I don't think people understand just how close we came to a hidden crisis in the silver market, and why it could matter to everyone, not just investors. Silver, the metal you probably only notice when you're polishing your grandma's cutlery set, or maybe when you spot a tarnished spoon at a flea market. It's easy to overlook, right? But beneath that unassuming shine, silver has a secret life, one that stretches far beyond the dinner table and into the heart of the global financial system. But to really understand why the market got so weird, we need to go back, way back. Silver's story is older than most currencies, older than many nations, and it's woven into the very fabric of human civilization. For centuries, silver was more than just a pretty metal, it was money itself. Empires rose and fell on the strength of their silver reserves, from the Spanish conquistadors hauling tons of it across the Atlantic to the American Wild West, where silver dollars fueled expansion. This metal shaped economies and destinies. Even today, echoes of that legacy remain. Silver was the backbone of trade routes, the foundation of entire monetary systems, and a symbol of wealth and power. In China, silver was the standard for centuries, and in Europe, it was the lifeblood of commerce. Wars were fought over it, and fortunes were made and lost in its pursuit. Fast forward to the modern era, and silver's role has evolved. It's not just for coins and jewelry anymore. Silver is everywhere. In your smartphone, in solar panels, in the wiring of electric cars, and even in medical devices. Its industrial demand is massive, and it's a critical ingredient in the technologies shaping our future. Silver's unique properties, its conductivity, reflectivity, and antibacterial qualities make it irreplaceable in many industries. Every time you swipe your phone, drive an electric vehicle, or rely on renewable energy, you're depending on silver, often without even realizing it. But silver isn't just for forks and teapots. It's a global commodity, traded by people in sharp suits, in glass towers, on trading floors that never sleep. Every day, billions of dollars worth of silver changes hands, its price flickering on screens from New York to Tokyo. The silver market is a complex web connecting miners, refiners, manufacturers, investors, and speculators across continents. It's a 24/7 game where fortunes can be made or lost in a single trade. For years, though, silver's price barely moved. It was the definition of dull, like watching paint dry or grass grow. Investors yawned, analysts barely bothered to check the charts. Silver was the quiet kid in the back of the class, but behind the scenes, something was brewing. The market's calm exterior hid a simmering tension, as supply and demand quietly shifted, and as new players began to take notice. The silver market has always had its share of powerful players. Major banks, think JP Morgan Chase, HSBC, and others, have long been involved in trading silver, both for themselves and for clients. These institutions, with their deep pockets and complex strategies, have the ability to move markets, sometimes in ways that aren't always obvious to outsiders. Their influence stretches from the trading floors of London and New York to the vaults where physical silver is stored. They use sophisticated financial instruments, futures, options, swaps, to hedge, speculate, and sometimes to quietly shape the market's direction. Over the years, there have been whispers, and sometimes outright accusations, of manipulation in the silver market. Investigations, lawsuits, and regulatory probes have come and gone, with some banks paying hefty fines for their role in rigging prices. But the system, for the most part, kept humming along. Regulators would step in, slap wrists, and the headlines would fade. Yet, for many, the sense lingered that the game was rigged, and that the real story was happening out of sight. Then, out of nowhere, everything changed. The price exploded upward, fast, wild, and totally unexpected. It was as if someone had flipped a switch, and suddenly, silver was the hottest ticket in town. The world's attention snapped to the silver market, and chaos erupted. News outlets scrambled to explain the surge, while traders scrambled to cover their positions. The experts were baffled. Their usual explanations, industrial demand, inflation, even global crises, didn't fit. None of the old models could explain what was happening. It was chaos, and nobody in the ivory towers had a clue why. The textbooks were useless, and the old hands on Wall Street were left guessing. The real story? It wasn't hedge funds or billionaires pulling the strings. It was ordinary people, teachers, students, office workers, organizing online, swapping tips on forums and social media, and buying silver en masse. They turned the market upside down from their living rooms. The movement spread like wildfire, fueled by memes, viral posts, and a shared sense of purpose. And they weren't just buying coins for their collections. They were piling into anything with silver on it. Futures, contracts, ETFs, mining stocks. If it glittered, they wanted in. The movement was massive, and it was everywhere. Dealers reported shortages, online platforms crashed under the demand, and the ripple effects reached every corner of the market. Their theory? that big banks and institutional players had been quietly suppressing silver's price for years, keeping it artificially low to protect their own interests. Now, the crowd was determined to expose what they saw as a rigged game. Online, theories multiplied, and every new piece of evidence, real or imagined, fueled the fire. This was their moment to call the bluff. Armed with memes, message boards, and a sense of mission, they set out to challenge the giants of Wall Street. It was more than just a trade, it was a movement, a rebellion against a system they believed was stacked against them. It was David versus Goliath. If David was a swarm of Reddit users and Goliath was the entire financial establishment, the internet had given the little guys a slingshot, and they were aiming straight at the heart of the system. For the first time, technology allowed ordinary people to coordinate and act with the speed and scale of the biggest institutions. The big players who'd been betting on silver staying low suddenly found themselves in trouble. As prices soared, panic set in. Phones rang off the hook. Strategies unraveled in real time. Some funds scrambled to cover their positions, while others tried to downplay the chaos. Short sellers, those who'd gambled on silver's price falling, were now staring down massive, unexpected losses. The tables had turned, and fast. Margin calls went out, forcing some to sell other assets just to stay afloat. The domino effect rippled through the market. The system that had always worked for them was now turning against them. And it was happening in public, with every loss broadcast for the world to see. The old rules no longer applied. The transparency of the internet meant that every twist and turn was instantly shared, analyzed, and debated by millions. For the small traders, it felt like they were on the verge of a historic win, finally exposing the gap between paper silver traded on screens and the real physical metal you can hold in your hand. It was a battle for transparency, and for once the underdogs were winning. The debate over real versus synthetic silver became a rallying cry, with many demanding proof that the paper market was actually backed by physical metal. The party was wild, social media was ablaze, the price kept climbing, and for a moment it seemed like nothing could stop the momentum. The world was watching, and the energy was electric. Every new high was met with cheers, memes, and a sense that history was being made in real time. But as with any wild party, it only lasts until... That's exactly what happened. In the world of high finance, when the stakes are high and the pressure mounts, the rules can suddenly become flexible, especially for those with the most to lose. The financial markets are often portrayed as arenas of fair play, governed by transparent rules and equal opportunity. But history has shown, time and again, that when the established powers are threatened, those rules can be bent, twisted, or outright rewritten to protect their interests. As silver's price soared to unprecedented heights, the big banks and exchanges didn't just watch from the sidelines. They called an emergency meeting, not to protect small investors, but to save themselves and their own interests from spiraling losses. The New York Commodity Exchange, or Comex, and the Chicago Board of Trade, two of the most powerful exchanges in the world, were at the center of this storm. These institutions, with deep ties to the largest financial players, had everything to lose if the market continued its wild ascent. Under the pretense of restoring order to the market, these powerful players decided to change the rules mid-game. It was a calculated move, cloaked in the language of stability and responsibility. But behind closed doors, the real motivation was clear: to halt the meteoric rise of silver and protect the financial giants who had bet against it. The discussions were intense, with executives weighing the risks of inaction against the backlash of intervention. Ultimately, the decision was made, not for the benefit of the market as a whole, but for the survival of the institutions at the top. Their weapon of choice? Margin requirements. The amount of money you need to put down to hold a position. By manipulating this lever, they could control who stayed in the game and who was forced out. In a single night, the exchanges announced a dramatic increase in margin requirements for silver contracts, raising them by as much as 400%. For many traders, this meant they suddenly needed to come up with millions of dollars just to keep their positions open. The move was not only abrupt, but also unprecedented in its scale and timing. Margin calls flooded the market, and the pressure on traders was immediate and overwhelming. By suddenly and dramatically raising these requirements, they squeezed out the smaller traders who had fueled the rally, making it nearly impossible for ordinary investors to keep their positions. Many were forced to liquidate at a loss, watching helplessly as their dreams of profit evaporated overnight. The impact was immediate and brutal. Silver prices plummeted, and fortunes were wiped out in hours. For many, it was a devastating lesson in the realities of market power. The very mechanisms designed to ensure stability were now being used as tools of exclusion, shutting out anyone who couldn't meet the new, impossible demands. The announcement came late at night with no warning, catching everyone off guard except those on the inside. It was a move designed for maximum impact and minimum resistance. Insiders, major banks and institutional players, had been tipped off, giving them precious time to adjust their positions before the hammer fell. For the rest, the news arrived like a thunderclap, leaving no time to react or prepare. The timing was no accident. It was a deliberate strategy to ensure that only those with privileged information could escape the fallout. This was not a decision made for the good of the market or its participants. It was a move to protect the powerful, to shield the institutions that had the most to lose. The Hunt brothers, who had amassed a massive position in silver, were specifically targeted, but so were thousands of smaller investors who had simply followed the rules. Until the rules changed, the message was clear: the market would not tolerate outsiders threatening the established order, no matter how legitimate their actions had been up to that point. The market is supposed to be about price discovery, buyers and sellers coming together to set the price through open competition and transparent trades. But in this case, the exchanges intervened directly, distorting the natural balance of supply and demand. Instead of allowing the market to function as intended, the rules were manipulated to favor those already in power. The result was a market that no longer reflected the true forces of competition, but rather the will of those who controlled the levers behind the scenes. But when the wrong people start to win, when outsiders threaten the established order, the rules can change in an instant. The Hunt brothers were painted as villains, but the real story was about a system that refused to let outsiders win. The narrative in the media quickly shifted, casting the Hunts as reckless speculators while ignoring the coordinated actions of the exchanges and banks. Public outrage was carefully directed away from the institutions that had orchestrated the crisis, and toward those who had dared to challenge them. The referees moved the goalposts, shrank the field, and made sure only the home team could score. The game was never meant to be fair for everyone. The exchanges even introduced liquidation-only orders, meaning traders could only sell, not buy, further driving prices down and locking in losses for anyone caught on the wrong side. This one-sided rule change ensured that the market would collapse in the direction the exchanges wanted, leaving no chance for recovery or resistance. The playing field was not just tilted, it was completely redefined. This wasn't regulation in the public interest, it was self-preservation by a cartel losing control of the game they thought they owned. The exchanges, the banks, and the regulators all worked together to ensure the established order remained intact. The lines between regulator and participant blurred, as those tasked with overseeing the market became complicit in its manipulation. The very institutions meant to ensure fairness became the architects of exclusion. The so-called free market was only free when it suited those in power. When their dominance was threatened, freedom took a back seat. The lesson was clear. The market is only as free as the people in charge allow it to be. For all the talk of open competition and equal opportunity, the reality was a system designed to protect its own. The illusion of fairness was shattered, replaced by the stark reality of control and manipulation. When the system didn't work in their favor, they simply rewrote the rules, reminding everyone who really controls the game. In the end, the silver crisis wasn't just about price manipulation or market speculation. It was a stark demonstration of how power, influence, and self-interest can override the very principles the market claims to uphold. The events surrounding the silver crisis exposed the fragility of the so-called free market, and the lengths to which those in power will go to maintain their dominance. For those who dared to challenge the status quo, the message was unmistakable. Play by their rules, or don't play at all. And as history has shown, when the stakes are high enough, the rules are always subject to change. Let's break down margin, because in the world of futures trading, margin is both your ticket in and the trapdoor beneath your feet. It's the invisible line between opportunity and disaster, and most traders don't realize how thin that line really is. In futures trading, you only put down a fraction of the total value, your margin. Think of it like putting a small down payment on a house, but being responsible for the entire mortgage if things go wrong. This leverage is what makes futures so attractive, and so dangerous. With a small amount of money, you can control a huge position, but that also means a small move in the market can wipe you out. If the market moves against you, you can lose more than your deposit. It's like driving a car with a tiny insurance policy. If you crash, you're on the hook for the full damage. And in volatile markets, those crashes can happen in the blink of an eye. Margin calls don't wait for you to catch your breath. Overnight, exchanges hiked margin requirements for silver. Imagine your landlord suddenly demanding triple rent, due immediately, or you're out on the street. There was no warning, no time to prepare, just a cold, hard demand for more cash. Suddenly, traders needed 3 times as much cash to keep their positions. For many, it was like being told to pay off your entire mortgage overnight. Some tried to borrow, others sold off assets. But for most, the numbers just didn't add up. The pressure was immediate and relentless. This triggered margin calls. Pay up now, or your position gets liquidated. It's the financial equivalent of a kneecapping. Sudden, brutal, and impossible to ignore. For many, it meant watching their investments vanish in real time, powerless to stop it. Most small traders couldn't come up with the cash, so they were forced to sell. It's like being evicted from your home because you couldn't pay a surprise bill. The emotional toll was just as real as the financial one. Dreams shattered, savings wiped out, trust in the system broken, the forced selling pushed prices down, triggering more margin calls. A vicious cycle. It's a financial avalanche. Once it starts, it sweeps away everything in its path. Each sale made the next one more desperate, the losses more severe. The banks got exactly what they wanted, a cascade of selling that crushed the rally. For them, it was like watching their opponents fall into a trap they'd set. With deep pockets and inside knowledge, they could weather the storm or even profit from it. The small traders weren't wrong, they were just outgunned. It's like bringing a knife to a gunfight, no matter how sharp your blade. They had passion, conviction, and numbers, but not the resources to survive a rigged game. The system wasn't about who was right, but who could afford to play. In this game, the rules are written by those with the deepest pockets. Access, information, and influence. These are the real currencies of power in the market. The game was rigged to force them out. For small traders, it wasn't just a loss, it was a lesson in who really controls the market. In the end, the message was clear. Play if you dare, but remember who owns the casino. Margin hikes were just the start. As the silver squeeze gained momentum, the playbook shifted from defense to outright control. The initial response was to make it more expensive to participate, but when that didn't work, the next step was to simply change the rules of the game. Brokerages began restricting buying. Suddenly, you could only sell, not buy, certain silver assets. This wasn't just a technical glitch, it was a coordinated move to halt the rally in its tracks. Overnight, the rules changed, and retail investors found themselves locked out of the very market they had energized. With buying blocked, upward pressure on price evaporated. The market, once a battleground, became a one-way street. Down. The sell button was the only option, and as panic set in, the price tumbled even further. The outcome was inevitable. Prices tumbled, and panic set in among retail investors. But this wasn't just about numbers on a screen. It was about perception. The sudden reversal sent a message. The movement had failed, and the establishment was back in control. The falling price created the illusion that the silver squeeze had failed. Headlines declared victory for the establishment, while retail investors were left holding the bag. The narrative was everywhere. The little guys had lost, and the professionals had restored order. In reality, buyers were blocked from participating. The game was rigged, not by market forces but by those who controlled the rules. The very platforms that promised open access became gatekeepers, deciding who could play and who couldn't. The narrative flipped overnight. Retail investors were painted as reckless losers, while the banks and institutions claimed victory, portraying themselves as the responsible adults who restored order. The story was no longer about a grassroots movement, but about the supposed recklessness of the crowd. This was no accident. The crash was engineered, and the story was spun to justify it. Every move was calculated to protect the status quo and discredit the opposition. Behind the scenes, teams worked overtime to shape the message and control the fallout. The real manipulation wasn't just in the price, it was in the story told afterward. By controlling both the market and the narrative, the powerful ensured that, even in defeat, they could claim victory and convince the world it was true. The lesson was clear. When the game is rigged, perception is just as important as reality, and those who control the story control the outcome. The phrase "socialism for banks, capitalism for you" isn't just a catchy slogan, it's a sharp critique of how the financial system operates when the stakes are highest. This saga exposed the hypocrisy at the heart of finance. When the powerful are threatened, the rules bend, and the free market ideals we're told to believe in suddenly vanish. The world of high finance is built on the promise of free markets, but that promise is often broken when it matters most. Let's dig deeper into what this really means. In theory, capitalism rewards risk-takers and punishes failure. But in practice, when the risk-takers are big enough, failure is simply not allowed. The system is designed to protect its largest players, even if it means rewriting the rules overnight. For small traders and everyday people, it's pure capitalism. Win or lose, you're on your own. Every risk is personal. Every loss is yours to bear. There's no safety net. No one to call for help when the market turns against you. The dream is that hard work and smart choices will pay off, but the reality is often much harsher. When the market crashes, it's the individual who pays the price, not the institution. Families lose their savings, small businesses close their doors, and retirement dreams evaporate overnight. The pain is real, and it's immediate. There are no golden parachutes for the average investor, just the hard landing of financial loss. But for big banks and financial giants, losses are never personal. When their bets go wrong, they get the rules changed to bail them out. In 2008, when the global financial system teetered on the edge, governments around the world stepped in with trillions in emergency funds. The powerful rewrote the playbook, turning private risk into public responsibility. Suddenly, the risks that were supposed to be theirs alone became everyone's problem. And it's not just about bailouts. These institutions have access to resources and influence that ordinary people can only dream of. They lobby for favorable regulations, secure low-interest loans from central banks, and negotiate settlements that let them walk away with little more than a slap on the wrist. Profits are private, but losses become a systemic risk needing intervention. The gains are pocketed, but the pain is shared. It's a system where the rewards flow upward and the consequences are spread across society. As economist Joseph Stiglitz once said, the bankers get rich, and when things go wrong, the taxpayer picks up the tab. This isn't just a one-time event, it's a recurring pattern. Each crisis reinforces the same lesson. If you're big enough, you'll be rescued. If you're not, you're expendable. Margin hikes and trading bans weren't about protecting the market, they protected the market makers. The rules shifted overnight, not to ensure fairness, but to shield those who stood to lose the most. The game was paused, but only for some. In moments of crisis, the invisible hand of the market is replaced by a very visible hand, picking winners and losers. Retail investors found themselves locked out, unable to buy while institutions could still sell. The message was clear. The market is only free when it serves the interests of the powerful. Small traders who played by the rules were punished for winning. Their success was seen as a threat, not a triumph. Instead of being celebrated, they were sidelined, locked out of the very market they believed in. The message was clear. The market is only free when the powerful are winning. This double standard isn't just unfair, it's demoralizing. It tells ordinary people that the system is rigged, that their efforts and risks will never be rewarded if they threaten the status quo. The banks flipped the table when they started losing. When the outcome didn't suit them, they simply changed the game. The rules are flexible, but only for those at the top. This isn't just a recent phenomenon, it's a pattern that repeats throughout history. From the Great Depression to the dot-com bust, from the savings and loan crisis to the 2008 meltdown, the story is always the same. The powerful rewrite the rules to protect themselves, while the rest are left to pick up the pieces. It's like losing Monopoly, then declaring all the properties yours because you own the board. The illusion of fair play disappears when the powerful refuse to accept defeat. In the savings and loan crisis of the 1980s, hundreds of banks failed, but the largest institutions were rescued, while ordinary depositors and taxpayers bore the cost. The same playbook was used in the 2008 crisis, and again in more recent market disruptions. The cycle repeats, each time eroding public trust a little more. The double standard breeds cynicism and distrust. People see the injustice and lose faith in the system. Experts warn that this moral hazard, the idea that bad behavior is rewarded, encourages even riskier bets in the future. When fairness is just a slogan, trust evaporates. And, when trust is gone, the very foundation of the market is at risk. Without faith in the rules, people withdraw, innovation slows, and the economy suffers. The system claims to be fair, but in crisis, it protects its own. Regulators and officials act swiftly, but their actions often favor the established players, not the everyday investor. As former Federal Reserve Chair Paul Volcker once noted, the only innovation the banking industry has produced in the last 20 years is the ATM. Yet when trouble hits, it's the banks that get the lifeline. Attempts at reform are often watered down or delayed, as lobbyists and insiders work behind the scenes to preserve their advantages. The message is clear. There's one set of rules for the powerful, and another for everyone else. The club always wins, and the rest are left to play by rules that can change at any moment. Until this double standard is addressed, the cycle of crisis, bailout, and inequality will continue, leaving most people on the outside, looking in. If we want a truly fair market, we need transparency, accountability, and a willingness to challenge the entrenched interests that have shaped the system for decades. Only then can we hope to break the cycle and build a financial system that works for everyone, not just the privileged few. Beyond official rule changes, the silver market was plagued by shadowy manipulation, like spoofing. But this was just the tip of the iceberg. The rigging was systematic, coordinated, and executed in plain sight by powerful players with deep pockets and advanced technology. These weren't isolated incidents or rogue traders acting alone. Instead, entire teams, sometimes spanning continents, worked together to tilt the playing field in their favor, using every tool at their disposal, from high-frequency trading algorithms to direct influence over trading platforms. Spoofing is placing huge fake sell orders to scare others into selling, then canceling them to buy cheap. Here's how it worked. First, a trader, often using sophisticated trading bots, would flood the market with massive sell orders, creating the illusion of overwhelming supply. Other traders, seeing this, would panic and rush to sell their own positions, driving the price down. The process was lightning fast, with bots able to place and cancel thousands of orders in seconds, making it nearly impossible for regulators or ordinary investors to keep up. As the price dropped, the original spoofer would quietly cancel their fake sell orders and start buying at the new, lower prices. This cycle could repeat dozens or even hundreds of times in a single trading session, amplifying volatility and confusion. The result? A market that looked chaotic and unpredictable on the surface, but was actually being steered by a hidden hand. For retail investors, it was like playing a game where the rules kept changing, and the house always won. During the crisis, phantom sell orders hammered the price down. The effect was psychological as much as financial, spreading fear and uncertainty among retail investors, while institutional players with inside knowledge stayed calm and capitalized on the chaos. The panic was contagious, rippling through online forums, news outlets, and social media, convincing even more people to sell at a loss. Combined with trading restrictions, this created a fake picture of panic selling. The price chart became fiction, not fact. The numbers on the screen no longer reflected true supply and demand, but rather the will of those pulling the strings behind the scenes. Even experienced analysts struggled to separate reality from illusion, as the data itself was being distorted in real time. Real buying was blocked, while fake selling dominated. Key players, large hedge funds, market makers, and even some banks, used their influence to pressure trading platforms into restricting purchases, leaving retail investors powerless to fight back. For many, it felt like the rules were being rewritten in real time, always to the advantage of the biggest players. The market became a propaganda tool, not a discovery mechanism. Media outlets and analysts echoed the narrative that the price drop was natural, masking the manipulation happening in real time. Carefully crafted talking points were repeated across channels, drowning out dissenting voices and reinforcing the illusion of a fair market. The manipulators created the evidence they needed to justify their actions. Reports were written, data was massaged, and official statements were crafted to support the illusion of a fair and orderly market. Regulators, often overwhelmed or complicit, signed off on these narratives, giving them the appearance of legitimacy. They rigged the game, then claimed the outcome proved it was fair. The broader implication: when those with power can rewrite the rules and control the narrative, the market stops being a place of price discovery and becomes a stage for manipulation, leaving ordinary investors at the mercy of unseen forces. In the end, the real cost isn't just financial, it's the erosion of trust in the very system that's supposed to be fair and transparent for all. The crisis exposed the absurd gap between paper silver and physical silver, but how did this divide become so vast? And what does it mean for the market and for ordinary investors? To understand the Great Silver Divide, we need to look at how the silver market evolved and why so much of it now exists only on paper. Most trading is in futures and ETFs, paper promises, not real metal. These financial products were designed for convenience, allowing investors to speculate on silver prices without ever touching a single ounce. Over time, these paper instruments became the dominant way to gain exposure to silver, attracting both institutional and retail investors. The result? A market where the vast majority of silver owned is never actually seen or touched. The amount of paper silver traded dwarfs the actual physical silver available. In 2020 alone, the London Bullion Market Association reported that over 200 times more silver was traded on paper than physically existed in their vaults. This means that for every ounce of real silver, there are hundreds of claims, bets, essentially, on its price. The leverage in the system is staggering, and it's only grown with the rise of algorithmic trading and high-frequency strategies. For every real ounce, there are hundreds of paper claims. This imbalance is the heart of the Great Silver Divide. It's a system built on the assumption that most investors will never ask for delivery of actual metal. But what happens if that assumption is challenged? The system works only if no one demands delivery. As one bullion dealer put it, "We had customers lining up, but there simply wasn't enough silver to go around." When too many people want physical silver at once, the cracks in the system become impossible to ignore. Dealers faced unprecedented shortages, and premiums on physical silver soared. The silver squeeze threatened this. Buyers wanted real metal, not just paper. Some waited weeks, even months for delivery, only to be told their silver was on back order. The disconnect between the paper price and the physical market became painfully obvious. For many, it was a wake-up call about the risks of relying on paper claims. The banks couldn't deliver if everyone called their bluff. As financial analyst Dr. Karen Lee explains, the entire system is built on trust that most people won't ask for their metal at the same time. This is known as fractional reserve in the bullion world. Just like banks, the system relies on not everyone demanding their assets at once. That's why they had to stop the buying. It wasn't just about price, but about preventing a collapse of the paper market. Regulators stepped in, citing market stability, but many saw it as protecting the status quo. The intervention raised questions about fairness, transparency, and who the system is really designed to protect. If they failed to deliver, the whole system would be exposed as a house of cards. A single default could trigger a cascade, shaking confidence in the entire financial system. The risk isn't just to silver investors, it's to the credibility of the market itself. The emergency measures defended the illusion that paper silver equals real silver. As economist James Patel notes, it's a confidence game. The moment people lose faith, the illusion shatters. The liquidity in paper markets is only as real as the trust behind it, but one is a promise, the other is reality. The difference matters. For those caught in the middle, the Great Silver Divide is more than a market anomaly, it's a lesson in the risks of trusting paper over metal. As the crisis showed, when trust is tested, only the real thing counts. The divide isn't just about silver, it's about the foundation of modern finance and the dangers of confusing promises with possession. The fallout? It was more than just a dip in silver prices or a few angry headlines. What we witnessed was a catastrophic loss of trust, one that rippled far beyond the silver market itself, shaking the very foundations of the financial world. Investors, both large and small, began to question not just the value of their holdings, but the integrity of the entire system. The entire financial system runs on confidence. Confidence that rules are fair, contracts are honored, and regulators are watching out for everyone, not just the powerful. This trust is the invisible glue that holds trillions of dollars in assets together, allowing markets to function and economies to grow. Without it, every transaction becomes a gamble, every contract a potential trap. But when those rules are bent or rewritten to protect insiders, that trust is shattered. Take the 2021 silver squeeze. Retail investors were suddenly hit with trading restrictions, while big institutions kept their advantages. The message was clear. Regulation wasn't about fairness, but about keeping the status quo. The sense of injustice was palpable, fueling outrage and a sense of betrayal among everyday investors. Regulated market became a punchline. Regulated, it seemed, only to ensure the house always wins. Social media exploded with jokes and memes, and late-night hosts lampooned the idea of market oversight. The phrase, once meant to inspire confidence, now triggered eye rolls and sarcastic laughter. This wasn't the first time. From the 2008 financial crisis to the LIBOR scandal, history is littered with regulatory failures, each one eroding public faith. The silver market was just the latest example, exposing a clear divide: the paper market, now seen as a casino, and the physical market, viewed as a safe haven. Each scandal chips away at the belief that the system is designed to protect everyone, not just the privileged few. Many investors simply walked away from paper silver for good, disillusioned by a system that seemed rigged against them. Some closed their brokerage accounts, others shifted their focus to assets they could actually control. The exodus was quiet, but it spoke volumes. They wanted something real, coins and bars they could hold, not digital promises that could vanish with a policy change. For many, physical silver became more than an investment. It was a statement of independence from a system they no longer trusted. The market fragmented, paper prices became disconnected from real-world prices, and the gap only widened as trust evaporated. Analysts struggled to explain the growing divergence, while investors watched in disbelief as the numbers on their screens lost touch with reality. People saw just how easily the system could be manipulated, and how little recourse they had when the rules changed overnight. Forums and chat rooms filled with stories of frustration, suspicion, and a growing sense that the game was hopelessly rigged. The system broke its own credibility. In the end, the phrase regulated market became less a promise, and more a punchline, echoing through every corner of finance. Until trust is restored, the wounds left by these failures will continue to shape how investors view not just silver, but every so-called regulated market. The silver squeeze wasn't a market failure, it was a market working as it should. Ordinary people, armed with information and a sense of shared purpose, saw an opportunity, acted together, and forced the system to reveal its cracks. For a brief moment, the power of collective action was undeniable. The real failure was in the integrity of those running it. When the pressure mounted, the rules changed, not to protect the market, but to protect those in power. Regulators and institutions, instead of ensuring a fair playing field, closed ranks to shield themselves from the consequences of transparency. The game was stopped not because traders were wrong, but because they were right, and too successful. The system couldn't handle the truth being exposed. When the rules are rewritten mid-game, it's not just the outcome that's in question, but the very legitimacy of the game itself. The fallout, a market fundamentally broken, trust shattered. For many, the illusion of fairness was gone forever. The sense that the market was a level playing field, where anyone could participate and win, was replaced by a harsh new reality. Every future rule change will be viewed with suspicion. The scars of this crisis run deep, and the wounds are slow to heal. Investors now question not just the rules, but the motives behind them. The lesson is clear. When it's you versus a big bank, the system protects the bank. The playing field isn't level, and the rules aren't written for everyone. The power imbalance is no longer hidden. It's on full display. Investors are fleeing complexity for simplicity, real assets they can hold. Tangible value, not just numbers on a screen. The desire for something real, something outside the reach of digital manipulation, is stronger than ever. Not just silver, but gold, property, even crypto. Anything that feels real, outside the reach of sudden rule, changes. Diversification is no longer just a strategy. It's a shield against uncertainty. It's a search for value outside the reach of boardroom decisions. A move toward independence, and away from the whims of the powerful. For many, it's about reclaiming control over their financial future. The crisis revealed the truth. Financial markets aren't temples of capitalism, but private clubs with unwritten rules. Access is limited, and the doors close quickly when outsiders get too close. The illusion of openness has been shattered. If you want something real, don't trust a paper promise. Hold it in your hand. The only certainty is what you can touch. In a world of digital abstractions, physical assets offer a sense of security that paper cannot. We spoke to experts and everyday investors about what comes next. Financial historian Dr. Emily Carter explains, every crisis is a turning point. People are waking up to the need for transparency and accountability. The old ways are being questioned. She points to past market upheavals as moments when the public demanded, and sometimes achieved, real change. Retail investor Mark Nguyen shares, I'm done trusting systems I can't see. I want to know where my money is, and what it's really worth. For many, this is more than a financial decision. It's a personal stand for transparency and control. The future isn't certain, but the search for authenticity is growing. Investors are demanding more honesty, more access, more control. The next generation is watching, learning, and preparing to make their own choices. The call to action is clear. Educate yourself, ask questions, and don't settle for easy answers. The market may be broken, but the search for something real is just beginning. Communities are forming, knowledge is spreading, and the demand for change is growing louder. In a world of uncertainty, authenticity is the new currency. The journey isn't easy, but it's worth taking, together. The search for something real is not just a reaction to crisis, but a movement toward a more honest and resilient future. Now the question is yours to answer. Will you accept the system as it is, or will you demand something better? The cracks in the game have been exposed. What you do next matters. Reflect on what's real, what's fair, and what you're willing to stand for. Because the future of the market, and your place in it, will be shaped by the choice